And leadership in the market changes from gold to silver. When silver moves, it moves later, but it moves further and it moves faster. And by the way, Paul, if past is prologue, you won't need some cranky old guy named Rick Rule to tell you that leadership has changed. That circumstance is, in my experience, profound and dramatic. If the U.S. government was actually going to use gold as collateral, then revaluing the gold would be good. But Paul, if you owned a U.S. 10-year treasury and they forgot to pay you, and you went to Fort Knox to collect your gold, believe me, you would not walk away with a bar. You would walk away in bars. Of what value is that gold as collateral if it's not collateral? I think, I'd like to find out, not that it matters really, but according to the U.S. Constitution, that gold is mine. I'm a citizen. I'd like to know if that gold is there. I'd like to know, is it hypothecated? I believe it's there, actually. But the truth is, if it's mine, and they tell me it's there, they tell me not to worry, given all of the other truths they've told me, I'd like to know. I was a senior employee and the largest shareholder of a little outfit called Sprott. And if my memory serves me well, between gold and silver, we had a little bit, $16-17 billion worth. Nothing like the U.S. Treasury, but we audited it all the time. There are some very high quality audit procedures. The first thing you do is you send in a third party and they go 1 bar, 2 bar, 3 bar, 4 bar. This isn't very hard. And every now and then you take one of those bars and you drill it out around it and make sure that there's gold in it as opposed to tungsten. So it wouldn't be that hard for the U.S. government. It wouldn't cost that much money for the U.S. government to tell us, the people who the gold belongs to, that the gold is there and that it isn't hypothecated. The second part of your question, which is to say, what impact would it have if they revalued the gold? On credit markets, none. Because the debtor, the U.S. government, has aircraft carriers, aircraft, police, guns, bombs. How do you collect? Unlike most voters, I read a book, The Art of the Deal, by this guy named Trump. And he's fairly straightforward. Mr. Trump doesn't believe in a transaction that has two winners. He believes in a transaction that has one winner. He believes that you enter into a transaction for your benefit, and he's perfectly willing to eliminate an agreed upon benefit for the counterparty if he believes it's in his interest. He's a transactional person. I have lived my life, not always successfully, but I've lived my life in trying to occasion transactions where both parties benefited.
Same here.
Where the person who I bought from wanted to sell to me again, and where the people who bought from me wanted to buy from me again. That isn't what government's about.
No, I agree.
Trump is the ultimate politician. I think it was Gore Vidal. Maybe I'm getting my quotes wrong. I think it was Gore Vidal who said that you can understand politics if you look at the root of the word, poly from the Greek for many, and tick from the English colloquial for small blood-sucking insect. And if you think about the process as being a lot of small blood-sucking insects, each trying to extract the lifeblood of the other, and each trying to protect his or herself from his fellows, you understand the nature of politics, including Trumpian politics. Absolutely. That gold is allegedly security for Dutch obligations. The pile of Eurodollars in Europe is substantial enough that the Dutch could hypothecate their gold at home for US dollars, which have a lower cost of capital than euros, without having that gold held hostage by another sovereign government. In a circumstance where a sovereign issuer issues full faith and credit bonds, every asset and every call on that society is theoretically encumbered. What the Dutch government is telling you, and my government is telling me, is that our gold isn't specifically encumbered. I think in the near term that we are far enough away from a panic that holding GLD is fine. The articles of incorporation are a little scary because GLD is an ETF, meaning that its assets pinch and swell every day according to shareholder demand. There are days when more money comes into GLD than the counterparties have the physical availability of gold. And so GLD is allowed to accept, particularly from the primary counterparty, Hong Kong Shanghai Bank, delivery receipts. In a panic, GLD becomes, for part of their inventory, the unsecured creditor of the banking counterparties. When we set up the Sprott physical trusts, we set them up specifically because the guy whose name was on the door, Eric Sprott, said, well, there isn't much to worry about in GLD. I don't want to worry about anything with my gold. In other words, only physical delivery. That's why we didn't set it up as an ETF. We didn't want pinches and swells in the daily volume. We didn't want to have to transact daily. We didn't want anybody to have to owe us anything. Even in days when we have more cash that comes in, we don't have to buy gold on that day. We have to buy gold within 6 weeks. But my belief is, in the interim, until or unless things get really, truly ugly, where you're concerned about the viability of Hong Kong Shanghai Bank, JP Morgan Chase, you're fine owning GLD. I don't own GLD personally because I have very large holdings of our own product, the Sprott products. And there's enough liquidity on the New York Stock Exchange in the Sprott products that I don't have to own GLD, but I'm not particularly afraid of GLD. There is a whole class of investors and speculators, people who I know well, who are more paranoid than me and more paranoid than my former partner, Eric Sprott. These are people who say, if you can't hold it, you don't own it. And I have some sympathy with that. I shared that point of view when I was younger. I came to understand that there are risks there too. I label some of those people in the US midnight gardeners, buying physical gold and burying it in the backyard. The difficulty with that is if it becomes common knowledge, you tend to attract visitors whom you normally wouldn't invite over for breakfast. I've counteracted that myself by holding some physical in a bank vault. Well, more properly in a safe deposit box. I think, however somebody holds gold or silver, that they need to do it. I'm less fussy about how they do it. You'll recall earlier in this discussion, Paul, that we talked about the decade of the 70s in the United States. And we talked about the devaluation of the purchasing power of the US dollar in the decade of the 70s by 75%. We didn't talk about the fact that the interest rate in the United States went up threefold. For holders of the long bond, the 20-year, the 30-year, a threefold increase in the interest rate equates to a 70% devaluation of the bond. That's truly ugly. During that same period of time, many of your listeners won't have lived through that or thought about it, the gold price ran 30-fold. Now, I'm not suggesting that the gold price runs 30-fold from here. It's already up 12 times since the year 2000. But it wouldn't surprise me at all if beginning in 2025 and ending in 2035 or so, the purchasing power of the US dollar again declined by 75%. If that happens, I would expect a concomitant rise in gold. Back to it. 16 to 1 reflects the relative scarcity and abundance of gold and silver in the Earth's crust. But that doesn't matter. It doesn't go to utility. In other words, what's silver and gold used for? And it doesn't go to production cost. Most silver in the world isn't produced from silver mines. It's produced as a byproduct of base metals mines. And in that case, often the silver is effectively free. The mining cost is paid for mining copper. You just subtract the silver from the waste stream in copper production. So the idea that because the gold-silver ratio is 100 and the relative scarcity is 16, that doesn't mean much, except that in the near term, people's actions are governed by their thoughts rather than by reality. So in that sense, the gold-silver ratio becomes something. It becomes a justification to do something that somebody was going to do otherwise. In my experience, Paul, and I have to let history guide me, I've been through 3 precious metals bull markets in my life. And in each case, the bull market was led by the metal itself. It was led by the fear buyer. And that was the gold bullion market, not the silver bullion market. Once the momentum had been established in the gold bullion market and that price momentum had justified the gold narrative, and once the higher gold prices generated higher cash margins for gold producers, the gold stocks moved next. We've seen that happen in the last 14 weeks in equities markets. Gold led, by the way, driven by central banks, not by retail buyers. That momentum brought retail buyers in. They began to buy into the gold ETFs something like 30 weeks ago. That momentum just now, 13 weeks, has begun to find its way into the best of the best producers. What happens from here, make no mistake, we're in a gold bull market, is that leadership in the gold bull market begins to transfer from the best of the best to better valued but higher risk intermediate producers and small producers. At some point in time, when the momentum in the precious metals market attracts the generalist investor into the space, the generalist investor, for whatever reason, perhaps because of the lower unit cost, perhaps because of their reputation for volatility, particularly upside volatility, or perhaps for both, that investor puts part of his or her money into silver, not just gold. And leadership in the market changes from gold to silver. When silver moves, it moves later, but it moves further and it moves faster. And by the way, Paul, if past is prologue, you won't need some cranky old guy named Rick Rule to tell you that leadership has changed. That circumstance is, in my experience, profound and dramatic. And you know what? It doesn't actually matter. It matters to the speculator. People are always telling me, Rick, how can you own silver when you don't know what's going to move? Here's how I can own silver. 1970, the silver price was $1.40. 1981, it was $50. Let's say I'm 2 years late. Fast forward, 1990, the silver price is $4, $4.50. 1996, the price is $50. A 12-fold move. If I'm early 2 years at an 8% cost of funds or a 10% cost of funds, and what I'm looking at is a 10-fold move, people say when you're early, you're wrong. That's incorrect. If you catch a 10-fold move, if you're early, you're only a little bit less right. But the truth is that most people, well, let me rephrase it differently. Another great quote, Bernard Baruch. The only person who ever bought at the bottom and sold at the top was a liar. It didn't happen.